Hi, I'm Drew Meredith, a Director of Waddle Partners. I welcome Roy Keenan, Co-Head of Fixed Income at Yarra Capital Management. Welcome, Roy.
It's great to be here, Drew.
I think a good starting point would be to understand the underlying investments and the focus of your enhanced income strategy.
Yeah, look, the objective of the fund is to generate a return of cash plus 230 to 280 before fees. Pleasingly, as the manager for 21 years, I've been able to generate a cash plus 350 return. Obviously, the focus fund's income, which is a lot easier to generate today. But generally how we generate that income and yield across the portfolio is investing in senior bonds of both IG and high yield issuers. We play a big focus on also investing across the bank and insurance companies' capital structure, so senior, tier 2, tier 1. And we also focus on corporate hybrids. So we issue in subordinated debt or hybrids from corporate issuers.
Yeah, excellent. I mean, as an advisor, we've found investors tend to struggle with the concept of bonds still.
Yeah.
Yet you see, people are so comfortable with term deposits, but there's so much opportunity in this asset class. It'd be great to understand the benefits of your approach, which kind of focuses on a more selected part of the market and a more specialised,
Yep.
and how that works within a portfolio.
Yeah, so for me, it's there's a couple of things that I like in the way I generate returns. I think the first thing is I'm very benchmark unaware, so I'm not really worried about things I don't own. Whereas you own something that's you manage your fund versus a benchmark, you're always worried about what your mismatch against the benchmark. The other thing we try to do with our fund is we try to we have a very big, deep research team. And what we see ourselves as a 25-person investment team, and that research power that we think generates a lot of alpha and provides a lot of benefit in the way we do. We also have Tim Toohey as a top-down macro strategist, which helps us form views on interest rates, also sector positioning, and trying to pick the winners and losers. And I think finally the last thing is about our ability to invest along the capital structure. A lot of fixed income funds are very focused on just being invested in senior bonds, but we focus on bank and senior, bank tier 1 and tier 2, and look at the relative value and risk. And that provides a lot of opportunity for us as a manager of the enhanced income fund.
Yeah, I think that's something that's important to us as advisors when we're building portfolios as well, because so many clients come in and all their portfolio risk is coming from equities. So how do you split some of that into the debt side of the equation?
Yeah.
Be good to understand the type of other fixed income assets that your strategy complements well with, or where you see it sitting within portfolios.
Yeah, so first of all, we see, the way I think about the returns of the fund, it sort of enhances your income. It's reliable income. And through 21 years of running this fund, it dampens volatility. So we see a lot of clients using this fund to, in some ways, reduce their interest rate duration, enhance that income, but also a lot of users have historically used like the composite bond index. And today, the composite bond index that a lot of people use for their fixed income allocation, essentially that's only got 9% credit in it now. So years ago it had 50%, but now you're really not getting credit exposure by buying. So you're getting lower return and more government type exposure. What you find today in our fund, it's yielding around just over 7%. And if you look at historical average return of the last 10 years, the ASX 200, that's 7.1. So the opportunity set in this type of fund is, I just haven't seen it better for a long period of time.
Yeah, it's a big reason that we like it as well, and we see this part of the market as being open to active management, that you can add alpha through that. So from a core satellite perspective, you might still hold your composite bond in the core of portfolios at a low cost, but this is an area like other areas that benefit from active management.
Yeah.
I think with that in mind, it's probably worth looking at the recession risks that are growing. And I know whenever I talk to clients, they always talk about defaults. So good to understand how you apply risk management, and you talked about having quite a big team that supports that as well.
I always say to clients today that my job's a bit easier than 2 or 3 years ago because I've got income now. So I'm generating about 6.7% income. And what income does is protect you against potential risks. Now, recession is not my base case, but it's at back of mind because you can see that on potential on the horizon, especially as the central bank tightens rates a lot more. So I've just find, I think the one thing that's really interesting about this credit cycle though, and the way we've been sort of approaching the way we're managing our risk, is that corporate balance sheets ended this period in fantastic shape from the excesses of the pandemic. So it's a really good starting point tick sort of thing. But the problem is that you can't see interest rates rising this much without a default cycle. So for us, where is that default cycle? We see that default cycle in companies that have got too much leverage, and essentially they basically don't have business models that have been sort of tested for a cycle. Yep. So for us, what that means is that we've been moving up the credit curve. We're probably running the best credit quality in our fund. In some ways, you don't have to take a lot of risk to get really good returns. And the other thing that we've been very mindful of is we've been adding a little bit of interest rate duration. Historically, my fund sort of runs very limited interest rate duration. And that R word that you mentioned, recession, we've been sort of running about 1.5 years today of interest rate duration. Some of that's to protect income for the next 12 months, but some of it also is because we see a really good opportunity in like fixed rate tier 2 securities. Now, having a little bit of interest rate duration, if we do get recession, then essentially, we should see credit spreads and the economy deteriorate. If we get a recession, credit spreads move out, but we should see a rally in interest rates will offset that. And that's the way we've approached the market today.
Yeah, something we appreciate is the diversification across sectors, but parts of the capital stack. Yep. In the strategy, and I think the transparency in terms of almost humanising the investments in the portfolio so clients can connect with it. But it's great to have you here, and Roy Keenan, thank you.
Thank you very much, Drew.